Hi, it's John Kelly. In this module, we are going to discuss analytical procedures. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, research tells us that analytical procedures are one of the best procedures for initially indicating an error, not necessarily for finding the amount of an error, but for indicating that something is wrong and that there is a risk of material misstatement. This is the research result that sort of started this all off. And if you look at the top right there, ask the client and prior expectations. Those are two things that we would do as risk assessment procedures, having a chat with the client and comparing what's happened this year to our expectations from last. 26%, a quarter of all errors were found. And analytical procedures, scanning, analytical, and analysis, 48%. Almost half the errors in this study, which was done on a bunch of real audits. They asked auditors to find or to indicate what had initially indicated that there was an error, and this is what they found. So almost 75% of errors were found by what we would now call risk assessment procedures. And general testing and looking at estimates, another 10%. The interesting thing is tests of detail, which we think are the best tests in the world, only found 18%. So if we are doing an audit by starting with tests of detail and hoping that that's going to find stuff, we're only going to find 18% of the errors. And the risk assessment procedures and the analytical procedures will help us find much more. Now here's the study that was done, Hylas and Ashton, and it was done in 1982. You're going to say that's a long, long time ago. But this study influenced standard setters. It was done right before the Treadway Commission report, and the Treadway Commission picked up on this. And they actually cited this study, and this is what they said about analytical procedures in 1987. There exists a perception that these procedures have a relatively low degree of precision. And that was the perception then, and it might still be the perception now, that these simple, broad comparisons, this year to last year, why did this change, what's going on, these are very, very effective procedures at helping us identify risk of material misstatement. The other thing they said was, instead of being used as a planning tool, analytical review procedures are often mechanically applied by less experienced staff at the completion of the audit. And isn't that silly? And this comment was one of the things that caused standard setters to say analytical procedures should be used as a planning tool. The other thing it caused standard setters to say was the partner, when the partner is completing the audit and thinking about whether it all makes sense, the partner should apply, again, broad comparisons, analytical procedures, comparisons to expectations, to see if things make sense. So this had a significant impact, and that Hylas and Ashton study had a significant impact on auditing standards. Now, it was a long time ago. As I said, it influenced standard setters, and the point is that even the simplest of analytical procedures found errors, and more recent studies say the same thing. I had to cite this study just because I really liked the title, Analytical Procedures, a Defensive Necessity. In this study, they pointed out that the simplest of analytical procedures would have found the problem in some really major stock market disasters where financial statements were found to be wrong. And they looked at it and said, simple analytical procedure probably should have showed you that. So there are three kinds of analytical procedures required by standards: planning, risk assessment procedures; execution, substantive analytical procedures, and that could be just following on our risk assessment procedure and gathering a little bit of evidence from it, or it could be designing a substantive analytical procedure to get a substantial amount of evidence. And then there's the completion, the final check done by the partner. And of course, you would follow up anything you found. Now within that, I define three types. These are my definitions. I call them defensive analytical procedures, evidence gathering procedures, and procedures with absolutely no value. And the evidence gathering procedures, you need an expectation. You have to be able to say, this is what I think the numbers should be. You have to be able to support that expectation, because without it, when you find out analytically what's happened, you really can't determine whether that's unusual or not. And no value, there's just no way to come up with an expectation. Now, the simplest comparisons can be very, very effective, and they're risk assessment procedures. They don't necessarily give us evidence. We should document them. We say that we did them, and we record any unusual matters that we find in our documentation of risk of material misstatement, and that's an efficient and effective way to document our analytical procedures. Evidence gathering, you need an expectation, and it's getting more difficult as business changes more quickly to come up with an expectation. In textbooks, it's very easy to say we have a gross margin of 50%, and you can do an analytical procedure and see if that's present or not. Business is changing, lines of business are changing. It's often very difficult to find those expectations in real life. Now, you may have to disaggregate data. You may have to break it up by product line. I had one manufacturing client, and for the first part of their life, it was pretty simple to do analytical procedures. They had a standard markup. It applied to all their product lines. Their business was very steady. And then it started to change, and they started to have newer product lines with different margins. We had to disaggregate the data, do it by product line. Then it started to change by month, so we had to start to do the analytical procedures on a monthly basis. And finally, their business just got so variable that we decided that we were really having difficulty using the analytical procedures at all and had to stop and do something different. Now, we have to document what we've done. If we're doing them to gather evidence, we have to consider the suitability of the procedure, and that may well be implicit. We have to consider the data reliability, and this is one of the reasons that doing analytical procedures together with a systems walkthrough is so effective, because you may be able to conclude that the systems walkthrough you did gives you enough evidence that the data you're using for your analytical procedures is reliable. And we might have a checklist reminder to say, yes, I did a systems walkthrough, and that checked the data reliability for my analytical procedures. We will need an expectation, and you should document that in the audit program, and we should define what an acceptable difference is also on the audit program. Now let's use an example of an interest reasonableness test. There are two ways you could do it. You could assume an interest rate. Let's assume 4%. Do the math and find that at 4% interest, the interest expense should be $100,000. And the actual interest expense is $120,000. And there's a $20,000 difference. Now, the first thing to resist is resist the temptation to call that an error, because we're just doing a broad analytical procedure, and the client's number is presumably right. It's just that we have estimation error. And that's why you would have to say, if I'm going to assume an interest rate, I'm going to be happy if it's within $30,000. And I'm going to say that that then gives me the satisfaction I need. Another way of doing it, and I like this a bit better, is to calculate the effective rate of interest. And so you do the math and find that the effective rate of interest was 3.5%. And then you could say, well, I know that the line of credit, the interest rates varied between 3 and 4% during the year, so I'm prepared to accept 3.5% as reasonable. So I like doing analytical procedures that second way because it's easier for me to evaluate the difference. Analytical procedures that have no value at all. Comparing cash this year to last year. What is our expectation? Very, very difficult to come up with one. Maybe we could get a very small amount of satisfaction, but what's our expectation? Very difficult. Comparing accounts payable this year to last year. What's our expectation? And there I think it's almost impossible. Check runs are done at different times. Different things are purchased. It's just too difficult to come up with an expectation. Financial ratios like debt equity or times interest coverage, these have nothing to do with material misstatement in financial statements, and there's no way that we could come up with an expectation that would help us find an error. Now, if you were checking debt covenants or something like that, there was a times interest debt covenant, of course then you'd calculate it, but you're doing that to see if the covenant has been violated or not to assess risk of material misstatement or to obtain evidence that something's right. The other one that's difficult is advertising expense. It's at management discretion. Why is advertising expense up this year? Answer, because we spent more on advertising. Now, you might wish to do that as a defensive procedure so that when the client asks you at an audit committee meeting, hey, why is advertising expense up so much, that you'll be able to answer the question. So it might be defensive, but it's not going to give us any value, and there's really no point in doing and spending a lot of time documenting such procedures. So are analytical procedures oversold? Perhaps. Now, broad comparisons, low-level procedures, comparing this year to last, finding out why this changed so much. Those are low-level comparisons, but they're very good and they're very effective, and that's what Hylas and Ashton told us. Others tend to be manufacturing-based, days sales and receivables, things like inventory turnover, things like that. Those don't apply to most of our clients because most of our clients are not manufacturing-based, and they're getting harder and harder to do as business gets more and more complicated. Industry comparisons are often advertised. They are very hard to do, and they often do not work. So while they are advertised as something you can do, they often don't work. Now, things that can be effective if you are auditing a trucking company, inquiring about revenue per ton mile, that's a really interesting statistic. It's a commonly used statistic in the trucking industry. Airline industry use revenue per passenger mile. Those are interesting statistics. You will hear them discussed. And they are interesting on the sort of broad comparison level. As you're trying to find out what has happened in your client's business in the year, and as you're trying to think about where material misstatements could be hiding in the financial statements, they're a very good one to do. So we're required to document what we did. Now, there's no specific requirement to document. The only requirement would be that we documented enough for an experienced auditor to understand what we did. And if we have a series of checklist prompts reminding us to do the things that we're supposed to do, and if in our audit programs we have documented an expectation and documented what we think a reasonable difference are, and documented the procedure we did, that should be satisfactory for an experienced auditor. And that should be then appropriate documentation. So, thanks for listening.